Hello, I'm Kimberly Dondo, Digital Content Manager, and welcome to In Conversation With, the podcast series that delves into the world of financial services and brings you face to face with some of the most notable figures in the industry. Listen as we discuss topics that are currently facing the industry and hear from visionary CEOs to disruptive innovators as we bring you a diverse array of voices and perspectives. We'll explore the challenges they faced, the lessons they've learned, and the insights they have to share about the ever-evolving landscape of financial services. Hello and welcome to In Conversation With. I'm Kimberly Dondo, Digital Content Manager, and in this episode I'm joined by Nicolo Bragazza, Associate Portfolio Manager at Morningstar. So thank you for joining me today, Nicolo.
Thank you for having me.
Thank you. So can we just start with you giving us a bit of an introduction into yourself and how you got started in financial services?
Yeah, of course. So I've been working in financial services for 7 years now, basically all of them here in the UK. I've been working with Morningstar for next February 6 years. And my journey has started first as a fund selector, and then I joined Morningstar as an analyst to become then a PM, managing Morningstar portfolios here in the UK, manage portfolios, and now I co-manage also the multi-asset fund. And with regards to the Morningstar portfolios that I'm managing the passive strategy, the ESG strategy, which obviously will be the main topic of today. So looking forward to it.
Okay, so yeah, we are going to be talking about ESG, but off the basis of COP28 and its impact. So to kick things off, could you provide our listeners with an overview of what COP28 is, for those who might not know by now, and its significance in the realm of sustainable investing?
Yeah, of course. So first of all, COP28 is the 28th edition of the Conference of the Parties, from which we have the acronym COP. And this is within the framework of the United Nations Convention on Climate Change. Every year, leaders from around the world gather in order to assess the progress of climate change solutions and policies, and they try to discuss solutions in the fight against climate change. This year, the summit will be held in Dubai, and as per the letter sent by the incoming presidency, it will be mainly focused on 4 issues. The first is fast-tracking the energy transition. And the question around the reduction of emissions before 2030. The second will be around transforming climate finance. The third will be around putting nature, people, lives and livelihoods at the heart of the climate action. And the fourth will be mobilizing for the most inclusive COP ever. So obviously, this is a very important conference that is held every year, and it has some impact. I would say more indirect impact on the financial world rather than a direct one, especially the one of investing and the one that is really close to financial advisors. And this is because it has a more direct impact, because it may highlight certain themes and long-term goals that might be relevant for sustainable investors. So I would say that it is not really an action of central banks, which is obviously which obviously has a direct impact on markets, but it's rather more indirect. So by signaling the most pressing topics for policymakers, indirectly can also highlight the importance of certain long-term themes for investors.
Right. And how have the outcomes of previous COPs influenced the landscape of ESG investing? I know that you said that they've been indirect. So how have those influenced ESG investing and the role of financial advisors in guiding their clients?
Yeah, I think that it's always difficult to estimate the impact of a single annual conference in isolation, and how it may affect the landscape of ESG and sustainable investing. However, we can have an idea of how historically and over time the impact has been. And what we have seen since at least the end of 2015 with the Paris Agreement is that the size and the importance of sustainable investing have grown significantly. And this is true, by the way, across many dimensions. It's true in terms of assets. It's true in terms of products, and it's true in terms of the number of people showing interest in sustainable investing. And with people, I mean both investors, but also clients. There are still some geographical discrepancies in terms of adoption to sustainable investing. And this is especially true for the US, especially once we compare the US with Europe, which is really at the forefront of sustainable investing, I would say. If we look at and just to put things into more context, if we look at some of Morningstar figures when it comes to sustainable investing and the size of the market, we have seen that the size of the sustainable fund landscape has globally grown from around 500 billions in 2017, and it is now around 3 trillions.
Wow.
So we are talking of a 500% cumulative growth in 6 years. So obviously this is not just a function of a single conference, but it's more about the kind of signal that investors and financial companies have received over and over again and over time from policymakers, and the importance of sustainable investing overall. And I think that in this growth, advisors have had a very important role and still have a very important role, because they represent the first point of contact for investors, and they play a very important role in their understanding of the sustainable landscape and whether sustainable investing actually fit the financial needs of their clients, and whether it reflects their personal values as well, which is another important point of ESG and sustainable investing.
Yeah. Those are all very good points. And you've been leading the construction of Morningstar's ESG portfolio range for over 4 years now, which is very impressive. And could you share how these portfolios have evolved since their inception and what insights you gained along the way?
Yeah, absolutely. I think it's been a very interesting journey. So we launched the portfolios at the end of April 2019. And I think that the investment landscape was significantly different from today, especially in terms of product availability and the depth of ESG markets overall. On top of this, I think there was, so just to take a step back, we are valuation-driven investors, and so we pay a lot of attention to valuations, and we invest in those assets that exhibit the best expected returns adjusted for the risk, and valuation is a big part of those expected returns. And so when we launched the ESG portfolios, we also noticed that a lot of ESG markets looked more expensive than conventional markets. And this was as a product of the fact that, a function of the fact that these markets tend to have very low exposure to sectors that in the until 2022 were very cheap, like energy, financials, and what are called seen stocks, such as tobacco, for example. So given the low exposure to these sectors, ESG markets tended to be more expensive from a valuation standpoint, and also more exposed to growth stocks like tech stocks. And so when we started, and given that we are valuation driven investor, we were not just constrained in terms of the numbers of investment vehicles available at that time, because in the last 4 years, the number of products have grown really strongly. But also we were also constrained by what we could actually invest in based on the prices we were paying for those assets. And so this was a significant challenge that we tried to assess within our portfolios by obviously trying to overweight those assets that were more attractively priced and underweighting those assets that were least attractively priced. And this was obviously in consistency with our main exclusion criteria, because obviously our strategy has some exclusion criteria. And when then 2022 arrived, some of the worries that we had around valuations came into reality, as this price of expensive tech stocks overly represented in ESG indices started to fall, and our underweight to them were finally paying off. But I think that it's also important yes, 2022 was a very painful year for ESG investor. But last year, at the end of 2022, I wrote an article with the title 2022 Annus Horribilis for ESG, but the night is darkest before the dawn. Because I wanted to convey the message that when you have seen such a sharp drop in valuation, and you have seen also the rally in energy stocks on the other side, that means that the prospect for ESG stocks were significantly better than just 12 months before. And this was actually a good thing in the end for ESG investors.
Yeah. And with COP28 bringing increased attention to climate-related issues, how have you integrated climate considerations into the ESG portfolios you manage?
Yes. So I think it's important to point out, first of all, that our ESG portfolios are ESG generalist and pay more attention to the reduction in ESG risk. So we don't have a specific climate-focused mandate. I think it's important to point this out, because I think that with climate-oriented mandate, they usually have this kind of path toward net zero, and so they invest in those companies that are aligned to this path to net zero. We invest through funds, so we don't invest in direct stocks. So we have less. How can I say? We have less flexibility in this regard to decide the path. So we invest through funds, and so obviously we have a more generalist approach to ESG. And I would say that although we don't have a climate-focused mandate, environmental consideration indirectly affect our positioning. And this is through the fact that ESG risk, which is our main theoretical guiding principle, is a financial risk. And so if you are a big polluter, a big emitter, what you face is a very challenging environment for you, both in terms of regulation and the risk of fines that you may get, and lawsuits, and additional costs that you need to incur in order to be aligned to the net zero transition. And so given all this kind of risk, we have been structurally underweight all those sectors that are big emitters and polluters. And this translated into the fact that our portfolios generally receive the low carbon, they have a low carbon footprint, and generally they receive the low carbon designation, our ESG portfolios, which is a classification from Morningstar, which is given to funds with low exposure to fossil fuels and low exposure to carbon risk, which is a byproduct of the fact that we want to reduce ESG risk as much as possible. So we try to blend together financial and ESG consideration by saying, look, these are really the same thing.
Yeah. And as you said previously, ESG investing has gained momentum, but I do find that it is still something that is quite complex for both advisors and their clients. So what strategies or tools do you recommend for financial advisors to effectively communicate and educate their clients about the nuances of ESG investing?
Yeah, I think advisors have a very important educational role when it comes to ESG investing. And this is because there is an ever increasing number of labels and acronyms. And these obviously represent a challenge for, the end clients and investor that need to have a clear idea of what they are buying. They need to understand exactly what they are buying. And so advisors really need to help their clients in navigating the complexity of ESG investing. And can be done by highlighting the characteristics of investments from both an ESG and a financial standpoint, reminding their clients that there is a connection between the two elements and that ESG is not just about doing good. So I think in this regard, advisors need to explain to their clients that reducing ESG risk means reducing the financial risk of the companies they invest in, and therefore of their portfolios. And this is something that we have seen in the last few years, where actually ESG investing was just another way of doing growth investing in some ways. And this is also where advisors have a role, because when you invest in ESG markets, sustainable funds, you have certain exposures to the market. ESG investing is still investing, and therefore you need to be aware of those intrinsic biases of sustainable investing, because obviously as you exclude energy companies, as you exclude utilities with a lot of coal power generating plants, as you exclude banks involved in scandals, as you exclude tech companies with very poor treatment of their of customer data, all these kind of issues, you end up with a very restricted universe. And this means that you have different risk and returns compared to conventional markets. And so I believe it is very important to highlight that there are many shades of ESG investings, with impact investing being, I would say, the greenest of all, let's say. And that this kind of strategy not seek to make a positive impact along with providing a financial returns. And also I think advisors need to clearly tell their clients that with different shades of ESG investing, also different risk and return characteristics come along. And so what we have done at Morningstar was that we have been applying to ESG markets the same valuation-driven approach of the other assets, trying to estimate their expected returns and risk in order to construct better portfolios. Because as you get different exposures, you need to have different risk and return numbers, because it's the only way in which you can actually build better portfolios. And so this has led us, for example, that generally ESG markets had higher valuation than conventional markets, and also has led our underweight to US equities compared to UK equities. And instead we were more favorable of, for example, Asian equities or German equities more recently, for example.
Yeah. And you touched on talking about returns a little bit earlier, and I wanted to go back to that. As a portfolio manager, how do you address concerns from financial advisors who might worry about sacrificing returns for the sake of ESG principles? And we did talk about this briefly before we started recording, about how Rishi Sunak had kind of walked back some of those net zero goals. So then maybe some clients' perceptions might also lean away from, ESG principles because they don't know what their returns might look like in the future.
Yes, I think that's a very important point. And as I said, I think we have been noticing this kind of discrepancy between ESG and conventional markets since the beginning, in the sense that with higher valuations, we saw expected returns being lower. And this was probably against most of the conventional wisdom around ESG investing, because there is always a lot of excitement around the newest thing that drive up expectations of return. But actually, ESG investing is no different from other type of investing. You need to pay attention to valuation if you want really to get the highest and most attractive returns. I think that it's very important that a clear and honest conversation between advisors and their clients takes place when it comes to expected returns and risk and the opportunity cost of ESG investing. Because, for example, if you apply a very strict exclusionary approach, it is quite likely that your expected returns may be lower, and that the portfolio construction may be somewhat weakened. And this means that you cannot really, for example, you will be performing very well when it's the right time for you. But in most of other market environments, you will be penalized. And this is not great for investors that seek both financial and ESG goals at the same time, with the same degree of importance. So in this regard, I think that advisors need to pay attention to valuation, and they need to think about portfolios that are robust. And in this way, and in this regard, they should think of providing that kind of robustness by using alternative ways of providing protection and diversification. So you need to really use all your toolkit as an investor to provide that kind of, that kind of robustness to portfolios once you have reduced the exposures to certain part of the market structurally. Because tobacco stocks, for example, are very good historically have been very good for recessions, because they don't suffer to the same extent of other more cyclical sector. But if you exclude them from portfolios, you are excluding a way to provide some defensiveness within your equity allocation. And so where do you get that kind of defensiveness within your equity allocation? One way would be, for example, to think about a sector with similar defensive properties and maybe more aligned to some positive, to provide some positive impact as well. And one natural choice would be, for example, the healthcare sector. The healthcare sector is more defensive than other sectors such as financials or tech or communication services. But it's also aligned to some of the positive themes around providing better care and improving well-being.
Yeah.
So this is the way to blend together ESG and investment consideration to provide defensiveness to a portfolio. Once you have eliminated structurally the exposure to something that it's actually pretty defensive, such as tobacco. And I think that portfolio managers as well can still do a great job in ensuring that returns are good by paying attention to valuation and by constructing portfolios that have no strong bets and can withstand different economic and market environment.
Yeah. And kind of moving on from that, what you've talked about kind of highlights how there's always a question around, the performance of ESG portfolios compared to traditional ones. So can you share some insights into how the Morningstar ESG portfolios have performed over the past few years? I know that you kind of touched on it earlier.
Yeah, I think that we can have a look to, for example, we have the Morningstar database for models managed portfolios here in the UK, which is obviously our universe of reference for our portfolios. And obviously there are our peers are the sustainable portfolios. So what you've seen generally is that 2022, for example, for our portfolios, which was a very painful year for many managers, was actually, in relative perspective, a good year for our portfolios, because we were underweight certain tech stocks. We were underweight certain expensive areas of the market, and we had more UK stocks, which helped last year. And also, but obviously, if you compare since inception our UK ESG portfolios against our own strategies, such as the conventional ones, so with no ESG integration in the asset allocation, we can see that generally since inception they have performed in line. Obviously, until the end of 2021, ESG portfolios performed more strongly and better than the others. But then obviously in 2022, in these portfolios, we have a strong exposure to energy stocks. We had a strong exposure to other tobacco also stocks. And so they helped. 2022 was really and so in 2022, obviously ESG portfolio underperforms our active and passive portfolios.
Right.
And then in 2022 was a very challenging year for ESG markets more generally. Because we had what I would call a perfect storm. We had high inflation followed by higher rates, significantly impacting the high valuations of stocks. And then we had the war in Ukraine.
Right.
So these two things combined, and I will explain why it's so interesting to look at this, are really the perfect storm for ESG stocks, because think of the two things. So high inflation and higher interest rates impacting higher valuations. Generally, tech stocks were heavily represented in ESG portfolios, and so they got hit. But also the high inflation driven by commodity prices was a perfect tailwind for energy stocks. The perfect conditions for energy stocks materialized, and those were not represented in ESG indices. On top of that, you had a war, which means more demand for weapons. And defense stocks as well are not in ESG indices and funds because of their exclusion to weapons more generally. And so you really had all the sectors not represented in ESG indices having a fantastic 2022, whilst the sector most represented in ESG markets were the ones that suffered the most. So it was really a very tough year for sustainable investors.
Yeah, I can imagine. But I hope that we're coming on the other end of that tunnel, I guess. So looking ahead, I don't know, you might have a crystal ball somewhere there. How do you anticipate the ESG investing landscape to evolve, considering the commitments made at COP28? We don't know what commitments might be made. We don't know who might be walking back as well, joining with along with the UK. And how should financial advisors kind of prepare for any potential changes that might come as a result of that, directly or indirectly?
Yeah, I think, as I mentioned at the beginning, it is difficult to gauge the direction of travel from a single conference. And also, I think that the path for sustainable investing broadly has been already shaped from a product perspective. So we have climate focused solution will be an important part of the ESG markets, and we have seen the growth of these over the last few years. And I think that also more investors will gain familiarity with thematic investing, which allows to target specific long-term themes linked to the energy transition and the inevitable industrial changes that come with it. In addition to this, I think that another area that could be interesting is engagement. As some would point out, that improvement through engagement with companies make, some people would argue that through engagement you can overcome the traditional weaknesses of ESG investing, which is lower returns, because with engagement you are not really excluding the losers, but you are trying to engage with them in order to make them better and cause that re-rating that is particularly good for performance. So that may be another area of interest to look at for the next few years. And obviously, in this regard, advisors need to stay on top of the market and try to develop an even deeper knowledge of product and themes. And a lot of work, I think, should be done in explaining and communicating in plain language with clients about the nature of these themes and whether these may be suitable for the willingness and the ability to take risk of these clients, because obviously themes are implemented today with the companies that we have today, and so there is always an intrinsic element of risk here, because the perceived winners of today for a certain team or a certain investment development may not be the winners of tomorrow, which is what really matters for performance. So that's something that that's really an area where investors and also advisors need to be need to pay a lot of attention to.
Yeah. And lastly, could you share any resources or recommendations for further learning about ESG investing and its intersection with global climate agreements?
Yes, I think that we are lucky in the sense that the PRI website, it's really probably the first. It's one of the best sources of knowledge when it comes to sustainable investing, and they provide a lot of information around the most advanced conversation when it comes not just to sustainable investing and the theory and the theory behind it, but also when it comes to best practices to implement ESG and integrate ESG into investing. So really, I think that once you start looking at the PRI website, that's really where you can find very valuable and interesting information when it comes to sustainable investing. Obviously, there has been also a growth in certifications and learning materials that are available to people that wants to dig a little bit more into sustainable investing. But yeah, I think that the first thing to do is really to have a look to the PRI website, Principles for Responsible Investment, because it's really rich and dense, and there are a lot of information that that may prove very, very useful for advisors.
Okay, fantastic. Well, thank you for speaking with me today, Nicolo. I feel like I learned a lot about ESG, or a lot more.
Thank you very much, Kimberly.
Thank you for listening to In Conversation With. We do hope that you enjoyed it. Please do keep up to date with all our new releases via Podbean, Apple Podcasts, Spotify, and everywhere else you get your podcasts from. You can also keep up to date with all our new content published on the Money Marketing website, as well as our print edition Money Marketing magazine, so make sure to subscribe. Follow us on Twitter, LinkedIn, Facebook, and Instagram. See you next time.